Hello and welcome to another edition of Kathmere Capital Management's quarterly market and economic update webinar. I'm Nick Ryder, Chief Investment Officer here at Kathmere. We'll begin as we usually do with a brief review of market performance. Here we present the performance of a variety of indexes as of June 30th. You can see over on the left-hand side of the screen in the green bars, another strong quarter for global equities with US, international, and emerging market stocks all posting healthy positive returns. Really just an extension of what we saw during the first quarter, and you can see the year-to-date performance there in the blue bars. Purple bars represent over the previous 12 months, and you can see very strong trailing 12-month returns with US, international, and EM all up north of 30% over the previous 12 months. High yield bonds there in the middle, another strong quarter, some incrementally positive returns, just again an extension of what we saw during the first quarter and some pretty healthy returns again over the last 12 months. On the investment grade fixed income markets, they're both taxable as well as municipal. You did see bonds swing to a positive return for the quarter, a reversal of what we saw during the first quarter. You saw interest rates make a bit of a U-turn after having risen through the first quarter, did fall a little bit across the yield curve during the second quarter. And then on the far right-hand side, not a whole lot happening in kind of short-term bond and cash land as Fed's monetary policy has remained on hold, keeping interest rates on the short end of the yield curve right about zero. Here we take a look at just how historically unusual in many respects the last 18 or so months have been in global equity markets. This is a chart from Charles Schwab, just looking at the last 10 instances or the 10 instances in which the S&P 500 index declined 25% or more from an all-time high dating back to you see the mid-1950s. And you can see the black line showing the last 12 months here. So starting with the all-time high on February 19th of 2020 and running through the end here of the quarter. And you can just see how unusual the bear market and recovery were, both in terms of the speed really of the decline as well as the recovery, and just how that does stand out from a historical perspective. This slide here is in response to a question that we've been hearing a lot from investors kind of far and wide, which is this general reluctance or reticence to invest in an environment where the S&P 500 or the Dow Jones, whatever market index you look at, is at an all-time high. And so the concern is oftentimes, is now the best time to invest given that we are at an all-time high? In this chart here, coming from research done by JP Morgan, really the upshot here is that there's being at an all-time high is not something investors need to fear. If anything, according to this data, it's actually that investors should welcome the opportunity to invest in an all-time high. So just to orient what you're seeing here, JP Morgan looked at over the last 35 years or so, what happens if you begin an investment period on any random day or at an all-time high. So any random day representing the green bars, gray bars would be invested in an all-time high. And you can see that over 1, 3, and 5 year investment horizons, on average, you've actually done slightly better if you had started your period at an all-time high. I've seen other data looking at different horizons, extending back a little bit further in time, has shown broadly similar conclusions. At the end of the day, this isn't something that should necessarily be driving investment decision, but it does certainly, I think, work to assuage some fears that, hey, investing at an all-time high isn't something that we necessarily need to fear as investors. Here's an interesting bit of research or chart table that I came across from LPL Research. Just looking at what they call the first 6 months indicator, and this isn't something I think people should necessarily allow to sway their investment decisions too significantly. But what we're looking at here is, hey, the S&P 500 had a good first half of the year. What has that meant historically? And so LPL gathered up the previous 16 instances in which the S&P had a return north of 12.5% during the first 6 months of the year, dating back to the 1950s, and then looked how the stock market did over the second half of the year. And you can see that, generally speaking, strong first 6 months of the year has led to a continuation of that in the back half of the year, with 12 of the previous 16 instances, the S&P did register some positive returns, on average up about 7 to 10% per year during that horizon, so a little bit north of the longer term average. So again, not something that we think should overly drive or influence investment decisions, but just an interesting bit of historical fact here. Flipping here now is a chart again from another one that comes from Charles Schwab. Just looking at some market internals, we've talked a lot recently about a rotation in leadership in within markets, and Many of you may recall that last year, markets was really driven by kind of a top-heavy theme, right? The five largest stocks in the market really driving the ship. So by top five stocks, it's Apple, Microsoft, Amazon, Google, and Facebook. And what we're looking at here is just the performance of a basket of those five largest stocks versus that of the remaining 495 stocks. And you can see on the chart that for really the first 8 to 9 months of 2020, it was the top five, those big five stocks dramatically outperforming. You see all that basket of the big five outperform the rest of the market by about 60%. But then really from the late stages of last summer into the early fall, market rally broadened out a lot, right? The market has continued to go up over the last 8 or so months. But what you did see is that the remaining 495 stocks, so when you start to get into mid cap and smaller cap stocks, those stocks did take some market leadership and modestly, I'd say, outperform the five largest. So a welcome sign to be sure for diversified investors to see the rest of the market really start to participate and lead the way. Another kind of trend that we've talked about and watched over the last year and a half or so now has been um, this dynamic around kind of the stay-at-home stocks, right? Stocks that benefit from investors spending more time and money in their homes versus getting out and about and spending things. So, presenting here just from the market lows of registered last March 23rd, two different baskets created by Goldman Sachs: their stay-at-home basket and their reopening basket. And what you can see is that for the first 6 or so months of the market rally, it really was those stay-at-home stocks leading the way there. You see the blue line having market leadership and the orange lagging. But then right around October into early November, remember that's the time when we started to get some very positive news around vaccinations. Some economic restrictions were started to be lifted, and you did see at that point you had this kind of reopening trade really take hold. And so seeing the orange line kind of take off and really start to lead the market higher over the last now call it 9 months or so. So something interesting to watch there for sure. Turning our attention now to the economy, very simple chart here, just presenting total GDP or economic output in real terms, so net of inflation. And what you see is that following the sharp decline in the first and second quarters last year, we've started to recover pretty strongly. It's expected that during the second quarter that just recently ended, that output will reclaim new all-time highs. You'll see still a little bit of gap there. I just drew a rough kind of dotted line showing pre-coronavirus trend growth. So still an output gap to be sure for that, but recovering output during the second quarter of this year, to new all-time highs. Certainly a welcome sight, and just show how both sharp and severe the contraction was, but also the recovery as well, which is a welcome sign. A lot of what has driven this recovery, and this is an interesting chart here that I came across from Blackstone, has been the U.S. consumer. So personal or consumer spending has been extremely robust in its recovery over the last year or so at this juncture. On the right-hand side, we see personal consumption expenditures during the COVID recession. You see how sharp that decline was during the first quarter of last year, but then importantly, how quickly that recovered. And you've seen consumer spending really eclipse kind of trend level spending as though the coronavirus never happened. And you can contrast that on the left-hand side then with the experience coming out of the global financial crisis, how it was a much more drawn-out affair. Consumer spending kind of grinded slower and lower for a while, and the recovery was much more muted. In fact, you never reclaimed kind of that trend level experience. And so, I take this chart as cause for cautious optimism that this recovery will be more robust, self-sustaining in many respects, as the consumer has held up relatively well, in large part probably because of the massive amounts of fiscal spending that did come from the federal government. But you saw the consumer really power this recovery, and we kind of expect that to continue going forward. Looking at the labor market now here, we have, the chart on the left is one we've shown previously in different iterations, just shows total non-farm payroll, so the amount of people employed across the economy. And you see the solid, steady progress we made towards recovering all the jobs lost. Just to put some rough numbers on it, about 23 million jobs were shed during the 2 month downturn there in the first and into second quarter of last year. We've recovered about 16 or so million of those. We're about 6.5 million jobs shy of the highs from February of 2020. What's interesting to see is you'd see that about 7 million people at least that are ready, willing, able to work. And then the right hand side shows that job openings in the economy has reached an all-time high. And this kind of squares with some of the anecdotes you hear about employers struggling to fill open positions, particularly at some of the lower paying scales of the economy. And so you see about 9 million and change job openings as of May. I think this is a partially good news story in many respects because you do expect, employers are ready and willing to hire. I think some of the things that have held people back from taking jobs will be set to fade, whether it's, fear of contracting the virus, whether it's been lack of childcare options given, schools hadn't been fully reopened when the summer rolled around. Also, some of the expanded and enhanced unemployment benefits that did, potentially distort labor markets, those are set to fade coming into the part of the fall. And so I think, this is a good news story in many respects is that we do expect the labor market to continue to heal and recover and reclaim those jobs lost during the downturn. We'll turn here now just to inflation, something that's obviously received a lot of attention lately and for good reason, as we do think it is one of the key risks investors do face looking forward. What we're just showing here is core consumer price index inflation or CPI inflation in the core, meaning that it just strips out the more volatile kind of food and energy components. And you did see a sharp surge or a spike in inflation in recent months. These is looking at year over year levels, really approaching levels we hadn't seen since the early 90s. Monetary policymakers at the Fed have been adamant and steadfast in their belief that they do think that this inflation will prove transitory. Part of it is doing to just kind of statistical factors that you're making easy comparisons to a year of depressed price levels from a year ago. The other part, the Fed will acknowledge that there have been some disruptions in supply chains related to the COVID crisis, some of the labor market distortions. They believe that all these will resolve themselves and that this spike in inflation will prove to be temporary and transitory. Many on the other side may argue that sustained inflation is a key risk. We agree that it is. I don't think it's the base case. I think there's a risk that it does become sustained. But right now, I think our base case would be that this is transitory, but we're certainly mindful of the risk that it could be something worse and that, inflation may continue to move higher and stick around and be around for a longer time, which we do think would be a source of risk to equity markets for sure and the economy more broadly. One thing that does give us some optimism on why we think inflation may prove to be transitory is just that inflation expectations remain pretty well anchored at this point. So people aren't expecting inflation to remain along, and you can see why inflation expectations are important here. Because if people come to believe that more inflation is expected or that it's going to be around for, longer, that's going to change your behavior. You're going to, as a consumer, I want to rush to go buy things now before prices rise. If I'm a worker, I'm demanding higher wages now, and employers may be willing to give those, knowing that they can then raise prices on their hand. You can kind of see how that becomes a self-sustaining cycle. Right now, we see both market-based inflation measures there, while we're having jumped a little bit, remain pretty well anchored at 2.5% over the next 5 years. So this is the inflation expectations in Treasury bond prices. And then consumer inflation expectations as measured by surveys done by the University of Michigan. You see inflation over the next year expected to pop. That makes sense, but over the longer kind of 5 year horizon, consumers really not too terribly fearful or expecting a ton of inflation over the next 5 years, which is a welcome sign. So this is something we're going to continue to monitor closely. To the extent these do become unmoored or on anchor, that would really start to elevate the concern in our mind, but we're just not there in worrying too much about runaway inflation, though it is something we certainly are cognizant of when we think about positioning client portfolios. So I'll wrap things up here with just a brief executive summary. We talked about the historically strong equity market recovery remaining intact, another strong positive quarter for global stocks, and the trailing returns just look strong at this juncture. We alluded briefly to the concern about investing at all-time highs. We say that at least looking at historical data, investors need not fear investing at all-time highs. We think at all-time high is just as good as at any other time investing, that in and of itself being at an all-time high isn't something we need to be terribly concerned with. Right, the leadership within equity markets has shifted. It was very much kind of the defensive mega cap tech stocks, the more stay-at-home oriented. We did see some leadership shift to more cyclical, smaller cap value stocks, stocks that benefit from an ongoing economic reopening and recovery. Something that's started to peter off in the last part of the second quarter here, but certainly a dramatic change from the experience of last year. And from the economic perspective, obviously the economy continues to recover. Strong growth projected for the economy at large in the second half of the year, and continued growth expected into 2022 and 2023, albeit at slower paces than what we're likely to see this year. And then lastly, on the inflation perspective, there certainly has been a surge or a pickup in inflation over the last couple of months. We think it's a key source of risk, something to be mindful of and cognizant of. It's not warning signs or flashing red quite yet, but it's something that we'll continue to monitor closely and make changes or recommend changes on an as needed basis. So with that, I'll wrap things up and thank you very much.